Oil and gas producers Exxon and Chevron saw profits jump in the third quarter as oil and fuel prices climbed, but remain lower year over year. Now, both companies turned to the task of closing major acquisition deals. Chevron purchasing crude oil company Hess and Exxon to buy shale giant Pioneer Natural. Both companies doubling down on investments in fossil fuels, despite warnings from the international energy agencies of declining oil demand. Let's bring in Lipow Oil Associates President Andy Lipow to get his view on the sector. Good to have you back on the show, Andy. So give us an idea on this move to have these oil mega mergers at this point in time when the demand picture still is not clear. What are your takeaways from this?
Well, good morning, Rochelle, and thank you for having me. What we're seeing is a trend of mergers continuing throughout the oil patch as these big producers are flush with cash and they're looking for places to invest it. Even though the International Energy Agency is forecasting peak oil demand by 2030, that doesn't mean that oil demand is going to fall off a cliff in 2031. What these majors are looking at is it's difficult to find new areas of the world to replace existing reserves to satisfy this demand going forward in the future.
And so with that in mind then, especially when you have a backdrop of geopolitical tensions, a lot of wonders about China's demand picture as well, is this the right move at this time?
Well, I think these major oil companies are feeling this is the place where they get the best return on their investment, and it's in an area that they know what they're doing. For example, Exxon is buying Pioneer, and Pioneer has very good acreage throughout the Permian Basin, and Exxon is going to use its improved technology to get more oil out of the ground in conjunction with that acreage to make that investment pay off.
And I mean, so with that in mind, then, when you talk about the future of fossil fuels, obviously you see a lot of companies also still making investments in clean and green energy. Then, so what does that mean for the future of fossil fuels? Not just demand, but also on the supply side, and who's really going to be buying this?
Well, the supply side is really the difficult thing to come up with. Most supply reserves are really in the Middle East or in Venezuela and several other countries where U.S. oil majors and other integrated majors would rather not invest. While we go forward and we talk a lot about clean energy, the question is, can clean energy be delivered to the consumer at a cost-effective price compared to fossil fuels? Fossil fuels are going to continue to grow in demand in places like India, Southeast Asia, Latin America, or Africa that certainly don't have the infrastructure, if you will, to support the rollout of electric vehicles in a grand way, as they're still wrestling with providing electricity for day-to-day consumer needs in their homes.
Indeed. I mean, and when we look at some of the volatility that we've seen most recently in oil, started ticking up at the beginning of the Russia-Ukraine crisis. Didn't see as much of an impact following the Hamas-Israel conflict, though. But where do you see oil prices going from here? And what's going to be the next catalyst?
Well, I think that oil prices will continue to drift on up. I think you need $90 a barrel for WTI in order to encourage the next tranche of drilling, especially onshore as well as in the Gulf of Mexico. We've seen the drilling rig count come down over the last year. It's down about 19%, which means the oil majors are trying to do more with less expenditures. I think the catalyst for the next move up is actually twofold. One is the continued decline in worldwide inventories that's being precipitated by the voluntary production cuts that we're seeing out of Saudi Arabia and Russia. And of course, geopolitically, the oil market is watching the events in the Middle East to see if Iran gets drawn into the conflict directly. That presages a potential shutdown of the Strait of Hormuz, where nearly 20% of the world's oil transits on a daily basis.
And of course, one of the notable moves we saw this week, Warren Buffett upping his bet in Occidental Petroleum. What's your take on that, especially given how energy has fared so far this year?
Well, certainly it's a bet on price. Occidental is a huge producer here in the United States, and its stock price is really going to follow increases or decreases in crude oil and natural gas prices. And Warren Buffett is saying, oil demand is going to continue into the foreseeable future. And while it might be declining here in the US or have been peaked, the world continues to require more and more oil. And you do see that in the short term with the International Energy Agency forecast for increased demand this year and next year, as well as OPEC Plus's forecast for increases in demand over the next few years.
And so then as we look at the industry here, are more mergers and acquisitions, do you think, coming down the pipeline? No pun intended.
Well, I think they are. These two latest acquisitions and mergers, Exxon with Pioneer and Chevron and Hess, are continuing a trend. When we think about going forward, well, Devon Energy and Marathon Oil have been reportedly in talks in a merger valued at $17.5 billion for Marathon. On the natural gas side, we're looking at Chesapeake Energy as well as Southwestern Energy and another $12 billion acquisition. That leaves Occidental and Diamondback really as independents remaining in the Permian, and perhaps they're going to either acquire someone or be acquired as we just see the oil industry consolidate.
That'll be an interesting industry to watch there, to see more consolidation in this space and where it goes. A big thank you there to Lipow Oil Associates President Andy Lipow. Thank you so much.
Thank you.